Let's talk about something that is not talked about enough. IRS red flags. This is not to scare you, but really to prepare you. Because if you are a business owner and you're making good money, you're operating your business the way that you should, the last thing you want is unnecessary IRS attention. And the truth is, most red flags aren't intentional. They really happen because you don't know that it's a red flag to the IRS. So today I'm going to break down 6 major IRS flags that you need to know about and really how to avoid them. My name is Keisha Wandino. I am a real estate and business CPA and tax strategist. I help you pay less in taxes, keep more of the money you make, and build wealth in your business and your investments. So let's get into it. The very first red flag is underreporting your income. So truth is, if you make income, the IRS already knows about it. So that's income, whether it's W-2 income, whether it's 1099 income, marketplace sales from places like PayPal or Venmo. The IRS already knows that you have made their money. They are looking for you to report it on your tax filing. So when you submit your tax filing, they are looking to match the income that you're reporting against the income that has been reported to them. If you forget to include some of that income, it's an automatic mismatch, and that is when the IRS starts to send letters and let you know, hey, there's income that we have that you didn't report on your tax filing. I am not saying that you would intentionally leave off income, but sometimes it just happens because you are disorganized. So what you want to do is report everything. Assume that the IRS already knows about it, so when you submit it on your tax filing, they can match it with what they already have. The second red flag is reporting completely round numbers. If your tax return says your marketing is $10,000, you did $15,000 in travel, or you spend $8,000 in meals, those are all perfectly round numbers, and it looks like it was really just estimated. And estimated numbers tells the IRS that you're not tracking it properly, and they may have questions about that. Real businesses do not operate in perfect even numbers. So what you want to do is use an accounting software and report your actual figures, because your messy estimates may get the IRS looking at you all sideways because they know the reality of perfect round number. The next red flag is mixing personal and business finances. If your business account is paying for groceries and your personal account is paying for marketing, you have a problem. When you mix and commingle your funds like that, your deductions get blurry. And when you have blurry deductions, it's really hard to defend that against the IRS. So again, what you want to do is have separate accounts for your business and your personal transactions. Have separate credit cards for them. If you are really serious about growing your business and scaling your business and not being under the IRS radar, your finances should absolutely reflect that. The next red flag is having too many deductions compared to your income. Now, you know I love deductions because that's what I do as a tax strategist. But here's the key. The IRS expects your deductions to be relative to your income. So if you report $250,000 of revenue, but show $300,000 of expenses every year, and then that looks suspicious to the IRS, especially if you're claiming, let's say, 100% of your business vehicle, you have these massive travel expenses, or you have these huge write-offs. Another is if you are making $100,000 per year and your charitable contributions show that you are contributing $75,000 a year, then that looks suspicious to the IRS as well too. So again, deductions are not bad, but as you are reporting them, make sure that you have all the supporting documentation for it, that you can verify what the deductions are, what those expenses are. So if the IRS come knocking and they have some questions, you can present to them everything that they need to show that it is a qualified deduction. The next red flag is having consistent business losses. If you have business losses year after year, the IRS may start questioning whether you actually have a business or a hobby. They understand that losses are normal, especially when you are in years of growth. But if it's consistent, you need to be able to show that you're actively trying to make a profit, that you have a business plan, and that you're operating like a real business. So that means that you need to be operating with intent. You need to show that you are actively trying to make a profit as you are operating your business. And the last red flag is if you are operating your S corporation and you have no payroll. Now, this is a big one. If you elect to be taxed as an S corporation and you are not paying yourself a reasonable salary through payroll, that is a red flag. You can't just take distributions distributions, and skip payroll. The IRS expects for you to have W-2 wages, payroll filings, and the proper tax withholdings. I see this mistake happen all the time. People want tax savings, but they don't want to follow the rules when it comes to operating as an S corporation. You don't want this to be a red flag to the IRS. So what you want to do is set up your payroll, pay yourself correctly, and once you have a plan in place for actually paying yourself, you can take distributions. So as you can see, there are several red flags that can be triggered with the IRS, but let me say this and let me be very clear about it. Red flags does not automatically mean an audit. Audit does not necessarily mean that you're doing anything incorrectly, but the IRS does use algorithms. They compare your return to others in your income bracket and your industry. And if your numbers look drastically unusual, it gets scored a little higher, and high earners get looked at a little bit more closely. So the goal is definitely not to be afraid. The goal is be structured, make sure you have proper documentation and supporting information so if the IRS starts to ask questions. And the overall way that you're going to protect yourself if the IRS does ask questions is you want to have clean monthly books and financial statements. You want to show them that you are keeping your finances separate, you have your proper payroll set up, that you have documented all of your deductions, and that you have a true strategy with how you are operating your business. High income earners do not avoid the IRS, they avoid audits, and they avoid being penalized by being organized within their business. If you're not sure whether your business has red flags or you're not operating properly and you want to put strategies in place in order to save on taxes, use the link in the description box below to book a tax strategy session with my team. We can review your setup before the IRS does. I hope this video has been helpful for you. Make sure that you like, comment, and you subscribe so you don't miss out on any future tax strategies. I look forward to seeing you in the next video. Bye.